The purpose of this video is to help Year 12 accounting students know and understand how to analyse inventory turnover. In particular, how they can do an analysis that actually connects inventory turnover to other turnover measures, such as accounts receivable turnover and accounts payable turnover. It's recommended that students watch this video after they've watched How to Analyse Inventory Turnover Part 1. So looking at inventory turnover, we can see that there's actually lots of connections between this measure and APTO and ARTO, or account payable turnover and accounts receivable turnover. So you can see here, this diagram comes from the Cambridge text for Year 12 accounting, and they've actually broken this down really nicely for us. So we can see that with the red arrow, we've got the purchase of inventory going all the way over to the account payable. So we need to think about how these two things are connected. So when we purchase inventory, most of the time we're going to do this on credit. And so whenever we purchase inventory, that's going to lead to a payment that needs to be made to our supplier or our account payable. So we can see that there's a connection between the inventory we purchase and the amount we have to pay back to our suppliers. The second one we've got here in blue is the purchase of inventory to the sale of inventory. And we know that there's no point purchasing anything unless we're going to try and then sell it. So this then connects us to our last part in green, which is when we make the sale of inventory, sometimes we do that on credit, and that then means that we have accounts receivable, and we will eventually receive cash from them for that sale. So we can see that inventory account, account receivable account, and account payable account are all connected. And that means that the indicators and the turnovers are connected as well. So some things that we want to do can help us manage inventory, and they're going to have an effect on things like our accounts receivable turnover and our accounts payable turnover as well. So we've got here a big list, and to give you an example, some of the things that we could do would be to market strategically, effectively and ethically. Now, if we promote our inventory well through marketing, that's then going to lead to a boost in sales. So if we've got our inventory up in this part here and we market it well, that's going to increase our sales, which is then going to increase our receipts from accounts receivable. And if we've done our job well, those higher sales are going to drive a need for us to purchase more inventory, so then we can sell more, so then we can receive more. And we keep going through this kind of cycle. And this cycle is called the cash cycle. How our cash moves through the business, from using it to buy inventory, to then selling that inventory, to then getting the cash back from it, to then using that to buy more inventory, etc. So all of these strategies here are really good ones to use if you get asked a question about how to improve inventory turnover, but it's also important to know how they're connected. So let's have a look at a theory question. This is taking a business, Terry's TVs, and they've provided us with the following information. They've given us our 3 turnover areas, they've given us the data from 2020, and they've given us a comparison. And you can see that it's either from the previous period, or they've given us things like credit terms. So in addition, we've got a bit of additional information here. Terry has stated that since the business has brought in more expensive brands of TVs, the inventory turnover has increased dramatically. Now, he doesn't mean that that's improving. He actually is meaning that it's taking longer, and we can see that because between 2019 and 2020, it's gone up by 6 days. So this question asks us 2 things. Discuss the effect the change in inventory turnover has on the performance of Terry's TVs. Suggest a strategy to manage inventory that Terry could implement to improve business performance. So we've got 2 task words here. Discuss, so looking at multiple perspectives, And what are they getting us to discuss? They're getting us to discuss the effect of the change. The change in what? Inventory turnover. So if I was going to reword this question, it might be, how has the slowing down of inventory turnover affected our performance? And I need to look at multiple factors. So this is a really good question to bring in some really deep knowledge here of this cash cycle. The second part is a suggestion. So suggest a strategy to manage inventory that Terry could implement to improve business performance. Now in this case, a lot of students simply go, I'm just going to list one of these. But in order to get the full marks, we need to connect to this idea of improving performance. And so really strong results and responses will not only tell us what the strategy is, but they will say, how will it improve performance? How is it going to change, in particular, the inventory turnover? So if you want to have a go at this question, this would be a good, between 4 to 6 mark question. If you want to have a go, you're welcome to pause the video and then we'll have a look at a model response. So this is how you might break down your discussion. You might want to have a look at each of these indicators and then think about how they're connected. So for example, with inventory turnover, that's our focus in this question, because remember it's asking us in particular about that one. What has happened to it? What does this mean? Is it satisfactory? Why is it satisfactory or not? What does this mean for performance? All of these questions need to be answered. I can then bring in the other data because they've given it to me for a reason. It's not just sitting there to look pretty. So I probably want to connect these two other measures to inventory turnover. What are these telling me about performance? How might these impact inventory turnover? So if I have a look at accounts receivable, I can see that I am meeting the credit terms, or my customers are meeting the credit terms, I should say, by 2 days. But when I look at accounts payable turnover, I can see that I'm not meeting my credit terms my suppliers are giving me. In other words, I'm not paying them on time. So as a business, this could be a real problem, and my inventory turnover could help me to solve this problem. Under the suggestion, as I said before, what might we need to do to improve? What's the strategy? And then how? So looking at a model, you can see that we've gone through and followed those kinds of sub-questions to break this down. Some key elements in here. I've started off my response really similar to the one I did in the previous video by explaining what's happened in the inventory turnover. It's slowed down by 6 days, from 48 days to 52 days. I've used all that data and I've then said, what does this actually mean? And I've pretty much worked a definition in for my turnover there. I can also say that my accounts receivable turnover, and you can see I'm starting to say things like satisfactory, not satisfactory. And what this tells me, that customers are repaying their debts as they're due. But you can see here's where I'm bringing my discussion in. And you can see I'm using this kind of foregrounding to help the reader see that I'm bringing in my second point. So right now, it's taking me longer to convert my inventory to sales, but I'm not really finding any issues with my accounts receivable turnover. However, now I'm going to highlight another issue. When I look at the combined inventory turnover and accounts receivable turnover, this tells me that it might have some possible cash issues. And the reason why is even though my accounts receivable is doing okay against the measures, when I think about it in conjunction or with my inventory turnover, I can see it's taking me over 2 months to turn that sale or that inventory into cash in my pocket. 2 months. This then makes a whole lot more sense when I then go look at my accounts payable turnover, and I can probably see, well, if it's taking me 66 days to get cash from my inventory from customers, then it's probably going to make it really difficult for me to pay back my suppliers on time. So that's where I'm bringing in all 3 of these measures to help me deeply discuss and analyse what's happening with the inventory turnover. Then at the bottom you can see that I've got here the strategy, and I've got here what that strategy is going to be meaning. So you can see is I'm going to review the level of inventory, and I know that average inventory level is a really big part of the calculation of ITO. And then I'm going to talk about why this is going to help improve the ITO. It's going to decrease my costs of storage. It's going to decrease my risk of loss, decrease my risk of write-down. And I can also then connect it to the particular business. And you can see I'm actually talking about televisions in particular. And I'm talking about this idea that the risk of obsolescence is quite high with technology. Reducing the level of inventory on hand would improve the ITO, and I know that from the formula. And it would reduce the amount that I owe to the account payable, which would also improve the APTO. So I'm making a suggestion that I'm using all that data to help me. So quite a complex question, one that's worth practicing, and then you can use this model response and tweak this. This is by no means a perfect response. There's still lots of improvement that can be made here, but this gives you an idea of the kind of depth that we're looking for in accounting.